Most people think the Federal Reserve controls interest rates. It doesn't. That might sound strange given how often we hear headlines like, "The Fed cuts rates," or "Powell raises rates." But the truth is, the Fed's actual control over your mortgage rate, your auto loan, or even the yield on a 10-year Treasury is limited and getting weaker by the year. The Fed only manages two levers. First, the federal funds rate, the rate banks charge each other for overnight loans. Second, its balance sheet, the massive portfolio of assets it buys and sells to inject or drain liquidity from the system. When you hear the Fed raised rates, it's really just adjusting the target for that overnight lending market. Right now, that target sits around 4%. But here's the catch. That number doesn't apply to you or me. It only applies to banks trading cash back and forth while the rest of us sleep. And there's roughly $3.2 trillion sitting in those Fed Reserve accounts right now, earning that risk-free rate. The Fed prints that money into existence and pays banks directly for parking it. So yes, the Fed controls that corner of the market completely, but it barely touches the broader economy. The Fed's second tool, its balance sheet, is much more powerful. Think of it as a giant brokerage account. When the Fed wants to stimulate the economy, it literally creates money and uses it to buy assets, mostly treasuries and mortgage-backed securities. That's called quantitative easing, or QE. When it wants to tighten, it lets those bonds expire or sells them back into the market. That's quantitative tightening, or QT. During QE, new money flows into the system and bond prices rise, pushing yields down. During QT, money is destroyed, literally deleted from existence, and liquidity drains out. Right now, the Fed's balance sheet sits around $6.5 trillion, down from its $9 trillion peak in 2022. When they were buying trillions in treasuries back then, rates collapsed to historic lows. Today, they're doing the opposite, shrinking that balance sheet, and rates should be rising, but they're not. So what's going on? To understand why long-term rates are falling while the Fed is tightening, you have to look inside the plumbing of the financial system. There's something called the reverse repo facility, basically a safe parking lot for cash. After the massive money printing of 2020 and 2021, banks were sitting on trillions in excess reserves. The Fed told them, "Don't lend that money out, give it to us instead. We'll pay you about 5% risk-free." And they did. Trillions of dollars piled up there. Cash that could have been used to lend to businesses or home buyers locked away at the Fed. That's what economists call the crowding out effect. When the Fed offers a 5% risk-free return, why lend at 6% with risk? Why issue a mortgage at 7% and take credit risk when you can park it at the Fed with zero risk? But the reverse is also true. Once the Fed starts cutting rates, that free 5% goes away, and banks look elsewhere for returns. Money flows back into the market, pushing yields down. That's one reason long-term rates are falling now. Markets are front-running future rate cuts. Big investors are locking in today's yields before they disappear. But none of that addresses the bigger problem, America's $38 trillion debt. Interest payments alone now top $1 trillion per year. The deficit keeps growing, and no one in Washington is talking about cuts. Every year, we borrow more just to pay for what we already owe. And that's why the Fed will eventually be forced back into QE, because the market will need someone to buy all those treasuries. Remember, in a fiat system, debt creates money. When the government runs a $2 trillion deficit, that's $2 trillion of new money flowing into the economy, fuel for future inflation. At some point, investors will look at 3% treasury yields and say, no thanks, unless they get paid enough to offset rising prices. We've been here before. After World War II, America's debt-to-GDP ratio hit 120%, exactly where we are today. To control borrowing costs, the Fed introduced yield curve control. It literally pegged rates. The Fed said, the 2-year will be 3%, the 10-year will be 2.5%. We'll buy whatever it takes to keep it there. That's different from QE. QE targets quantities. We'll buy $200 billion. Yield curve control targets prices. We'll make the 10-year exactly 3%. If we go down that road again, the Fed will own the entire bond market. It will force rates lower for the government while everyone else's borrowing costs rise. Why? Because if the Fed prints to keep government rates low, inflation returns. And if inflation rises, private lenders demand higher returns to compensate. Mortgage rates, auto loans, credit cards, all could climb even as treasury yields fall. That's the danger of central control. The more they intervene to help the government, the more they hurt everyone else. In the end, the Fed controls the shortest end of the curve, the overnight rate between banks. Everything else is a mix of market forces, foreign buyers, and fiscal reality. When you hear that the Fed cut rates, remember, it doesn't mean your mortgage is coming down tomorrow. It doesn't mean car loans get cheaper or credit card debt magically shrinks. The Fed nudges the machine. The market decides the price. And as America's debt mounts, the Fed's ability to nudge gets smaller by the day. We're heading into a world where monetary policy is just a mask for fiscal reality. And that reality is this: you can't print your way out of a debt trap forever. The Fed will keep pretending it has control. Politicians will keep spending. But markets and math always win in the end. That's why I've spent decades warning readers about debt cycles, currency debasement, and the inevitable shift from illusion to reality. Because when interest costs swallow your economy, you learn very quickly that the Fed never controlled interest rates at all. It was just trying to control the story.